Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report that is all about big money moves and a new face joining the board. Get ready because things are about to get interesting with Wayfair Incorporated. Before we start, if you appreciate getting straight insights from corporate documents like this one, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more filings and discuss investment strategies every day. Alright, let's jump straight into the heart of this report. Wayfair LLC, which is a subsidiary of Wayfair Incorporated, has just issued a massive chunk of debt. We're talking about $700 million worth of senior secured notes. These aren't just any notes, they're senior secured, meaning they're a top priority if things go south. And they're due all the way in 2032. Wayfair plans to use the money they got from selling these notes to buy back some of their older convertible notes, specifically those due in 2027 and 2028. They might also use some of it for general company stuff, like paying off other debts. Now here is where it gets a bit tricky and potentially exciting for stock market watchers. This $700 million issuance is significant, not just for the amount, but for what it means for Wayfair's financial structure. They're essentially refinancing and adjusting their debt profile. They're promising to pay a pretty decent interest rate on this new debt, 6.75%, which tells you something about the current market or perhaps Wayfair's specific situation. The bigger story here is the plan to buy back those convertible notes. Convertible notes are interesting because they can be turned into company stock. When a company buys these back, it can have a ripple effect. For Wayfair, this move could potentially impact their stock price. If holders of those old convertible notes have hedged their bets by buying Wayfair's stock, they might sell that stock back when Wayfair buys their notes. This could mean more shares hitting the market or fewer, depending on how it all plays out. It is a complex financial dance, but essentially, Wayfair is trying to manage its debt and potentially influence its stock. Now, a quick note on how these notes were sold. They weren't registered in the usual public way. This means they were offered and sold only to certain types of investors, like big financial institutions who are considered qualified institutional buyers, and some international investors. This is pretty standard for debt issuances of this size. It doesn't mean anything is wrong, just that it wasn't a public offering in the same way as selling new stock to everyone. Digging deeper into that new debt, it comes with a set of rules called covenants that Wayfair and its subsidiaries have to follow. These are pretty standard for this kind of debt. They restrict things like taking on more debt, paying out dividends or buying back stock, making certain investments, or selling off important assets. It is all about protecting the lenders, and this is an important, but some of these restrictions might loosen up if Wayfair's credit rating gets good enough. Specifically, if two of the major rating agencies give them an investment grade rating. That is a big deal for flexibility if they can achieve it. This part is important for investors too. If there is a change of control at Wayfair, meaning a big shift in ownership or management, the company might have to buy back these new notes at a premium. That is essentially a safety clause for the note holders, making sure they're not stuck with debt from a company they don't feel good about. Shifting gears a bit, we have some leadership news. Wayfair's board of directors has welcomed a new member, Hal Lawton. He is considered independent, which is good for governance, and there are no reported deals between him and Wayfair that would raise eyebrows as part of his new role. He is expected to receive a significant stock award under Wayfair's incentive plan, valued at $250,000 at the time of grant, which will vest over a year. They've also signed a standard agreement to protect him from certain liabilities as a director. This appointment signals Wayfair is bringing in new perspectives at the board level. Now, before we wrap up, Wayfair, like most companies, includes a forward-looking statement section. This is essentially a disclaimer. They're telling you that when they talk about future plans and expectations, like using the money from the new notes or potential stock price impacts, these are just expectations. Real-world results could be very different. They're warning investors about risks and uncertainties that could throw those plans off track. It is important to remember this cautionary note when reading any company's projections. Let's zoom out and look at the bigger picture here. Wayfair is making a strategic move with this debt issuance. They're raising a substantial amount of capital, primarily to manage their existing debt. This often signals a company looking to strengthen its balance sheet, perhaps to weather economic uncertainties or to free up capital for future growth. The fact that they are buying back convertible debt could be aimed at reducing potential dilution to existing shareholders if those notes were converted. However, the high interest rate on the new debt, 6.75%, is not insignificant and will be a recurring cost for the company. The appointment of Hal Lawton to the board is a positive sign of proactive board refreshment, the risks highlighted in the forward. Looking statements are crucial reminders that the company operates in a dynamic and potentially volatile market. Overall, Wayfair appears to be actively managing its financial obligations and strategic positioning. The big debt issuance is a key financial maneuver, and the board change suggests a focus on governance. The future success hinges on their ability to execute their plans, manage their debt effectively, and navigate the ever-changing e-commerce landscape. Alright, that is our breakdown of Wayfair Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do let us know your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community linked in the description below for more discussions and insights. Thanks for watching. See you next time.